I learned early that the market never shouts its intentions. It whispers them. And if you want to spot a breakout early, you have to train yourself to listen to those whispers instead of chasing the echoes after everyone else has heard the noise. Most traders do the opposite. They wait for the headline, the excitement, the wide bars and fast tape, and then they wonder why they're always late. Have you noticed how that feels, watching a move run without you? You see, a breakout does not begin at the moment price explodes. It begins long before that, when nothing seems to be happening. The public is bored then. Volume dries up, price moves in narrow ranges, back and forth, wearing out anyone who lacks patience. That's not dead action, that's preparation. The market is resting, and rest is what strength looks like before it shows itself. Ask yourself, why would a strong stock need to advertise before it moves? When I watched price, I never looked for excitement. I looked for tension. Just like a man leaning back before he throws a punch, price pulls in before it strikes. You'll see it in tightening ranges, in higher lows that creep upward without fanfare, in resistance that's tested again and again but never breaks down. Each test tells you something. Sellers are hitting the market, but they're not getting anywhere. Doesn't that tell you who's quietly in control? Volume is your accomplice here, but only if you understand its language. Heavy volume at the wrong time is just noise. What you want is declining volume during consolidation, followed by subtle increases on up days. That tells you accumulation is taking place without urgency. Big interests don't rush. They build positions the way a carpenter builds a house. Slowly, deliberately, and without drawing a crowd. Have you ever noticed how the real move only comes after the crowd has lost interest? Price levels matter more than opinions ever will. A stock that holds above an old high, or presses against it day after day without backing off, is telling you something. Resistance isn't a ceiling, it's a test of conviction. Each time price backs away only slightly and then returns, it's like a man knocking on a door with more confidence each time. Eventually, the door opens. The breakout isn't the story, it's the result. Are you watching the result, or are you studying the cause? One mistake I see over and over is traders wanting confirmation from everything at once. Indicators, news, social chatter. But by the time all of that agrees, the market has already moved. Early breakout spotting isn't about certainty, it's about preparedness. You're not predicting. You're positioning yourself for a possibility that the chart is quietly suggesting. Can you accept uncertainty long enough to be ready when opportunity appears? A proper base is your foundation. The longer price moves sideways after a decline or a long advance, the more meaningful the next move becomes. Time is not the enemy, time is the builder. Weak hands leave during these dull stretches. Strong hands remain. When you see price refuse to break down despite bad news or a soft market, pay attention. Strength is often disguised as boredom. Does that change how you view quiet charts? Risk control is what gives you the courage to act early. Without it, early entries feel reckless. With it, they feel professional. You define your risk before you enter, not after price has already moved. That way, you're calm while others are emotional. You're thinking while others are reacting. And when the breakout comes, you're already aboard, not scrambling for a seat. Isn't that the position every trader wants? Your mindset matters as much as your chart reading. If you're desperate for profits, you'll see breakouts everywhere, and most of them will be false. The market has a way of punishing impatience. But if you approach each setup with detachment, willing to be wrong and ready to step aside, you start seeing the market more clearly. The goal isn't to catch every move. It's to catch the right ones with discipline. Are you trading to prove something, or are you trading to build something? Early breakout spotting also means knowing when not to act. Not every tight range leads to a meaningful move. Some are simply pauses before continuation lower. That's why context matters. Where is the stock coming from? What has it already done? A stock that has been building after a long accumulation tells a different story than one that's just pausing after a sharp drop. The chart always gives clues, if you're willing to read them instead of rushing ahead. I always believed that money is made by sitting, not by trading. Spotting a breakout early doesn't mean constant action. It means patient observation. You watch. You wait. You take notes, even if only in your head. When the market finally tips its hand, you act without hesitation, but not without thought. That balance is where consistency is born. Can you stay still long enough to see clearly? The market rewards those who respect it. It doesn't care about your hopes or your timeline. It only responds to preparation and discipline. When you learn to recognize the quiet signs of strength, the tightening ranges, the stubborn support, the subtle volume shifts, you stop chasing and start anticipating. And anticipation, when paired with risk control, is not gambling. It's professional speculation. Most traders spend their energy trying to be right. I spent mine trying to be ready. There's a difference. Being right feeds the ego. Being ready feeds the account. Early breakouts belong to those who accept that they won't always be right, but they will always be prepared to act when the odds quietly shift in their favor. And that's where the real work begins, in the silence before the move, when nothing is happening and everything is being decided. Most people think opportunity announces itself with noise. They believe the market rings a bell when it's time to act. I learned the hard way that it never does. The real preparation for a breakout happens when the chart looks dull, when nothing seems worth watching, when even seasoned traders start glancing away. That boredom you feel, that itch to do something, that's not a signal to leave. That's often the signal to pay closer attention. Have you ever noticed how the biggest moves seem to come right after you stopped caring? When a market is exciting, it's usually already too late. Fast bars, wide ranges, sudden volume spikes, those are the effects, not the causes. The cause happens earlier, in the quiet stretches where price barely moves and volume thins out. During those periods, weak holders grow impatient. They sell because nothing is happening. Stronger hands, the kind that move markets, are not impatient. They use time as a tool. While others complain about lack of action, they are positioning. Doesn't it make sense that the people with the most money would prefer to act when nobody is watching? Boredom is uncomfortable because it offers no immediate reward. There's no excitement, no confirmation, no emotional payoff. That's exactly why it's valuable. The market is designed to test patience before it offers profit. Price moves sideways not to confuse you, but to exhaust you. It shakes out those who need constant stimulation. And once that process is complete, there's less resistance when price finally moves. That's not coincidence, that's structure. Ask yourself, why would a meaningful breakout come when everyone is alert and eager? In these quiet periods, the chart tells a subtle story. You'll see ranges getting tighter, volatility shrinking, and pullbacks becoming smaller. Price may drift, but it refuses to break down. That refusal is important. A weak stock doesn't go quiet, it falls. Silence is not weakness, it's restraint. When selling pressure can't push price lower, despite plenty of time to do so, something is happening beneath the surface. Are you listening to that silence, or are you mistaking it for irrelevance? The public hates inactivity. They equate movement with opportunity. Professionals know better. They understand that preparation often looks like stagnation. Accumulation doesn't happen in one dramatic day, it happens slowly, carefully, so as not to disturb price. Volume often decreases during this phase, which confuses traders who think volume must always be high. But lower volume during consolidation simply means fewer sellers. The stock is being absorbed, not abandoned. Doesn't that change how you see those quiet volume bars? Boredom also reveals your own weaknesses as a trader. When nothing is happening, you're left alone with your thoughts. You start doubting your analysis. You start looking for action elsewhere. You start manufacturing trades just to feel productive. That urge is dangerous. The market doesn't pay you for activity, it pays you for discipline. Learning to sit through boredom is not passive, it's active restraint. Can you stay still when your instincts are pushing you to move? I found that the best opportunities often formed while I was waiting, not while I was trading. Watching a stock do nothing day after day teaches you more than watching it explode in a single session. You learn how it reacts to pressure, how it behaves near key levels, how quickly it recovers from small sell-offs. Those details are lost once the move begins. By the time excitement arrives, the information advantage is gone. Are you studying behavior before the crowd shows up? There's a difference between dead price action and constructive quiet. Dead action drifts lower, fails to hold support, and shows no signs of defense. Constructive quiet holds its ground. It moves sideways above important levels. It refuses to give back gains. The longer that condition persists, the more meaningful it becomes. Time adds weight to structure. A base that forms over weeks has more potential than one formed in days. Patience compounds just like capital, but most traders never let it. This is where mindset separates amateurs from professionals. If you measure progress by constant wins, boredom will defeat you. If you measure progress by preparation, boredom becomes an ally. You're not waiting for entertainment, you're waiting for alignment. You know your levels. You know your risk. You know what must happen for you to act. Until then, doing nothing is not avoidance. It's execution of a plan. Isn't following your plan more important than feeding your emotions? When the breakout finally comes, it often feels sudden to those who weren't watching. To you, it won't feel sudden at all. It will feel earned. You've seen the tightening. You've seen the refusal to break down. You've seen the quiet strength. The move doesn't surprise you. It confirms what the market has been hinting at all along. That confidence doesn't come from prediction. It comes from observation. Boredom teaches respect for timing. It reminds you that the market moves on its own schedule, not yours. Trying to force action during quiet periods leads to frustration and losses. Allowing the market to complete its preparation leads to clarity. The discipline to wait is the same discipline that protects you when you're wrong and rewards you when you're right. Most traders want the moment of release without enduring the tension beforehand. But tension is where opportunity is formed. Without boredom, there is no compression. Without compression, there is no expansion. The market obeys that rhythm relentlessly. Learning to recognize and tolerate boredom is not a side skill. It is central to spotting breakouts early. Because the trader who understands boredom doesn't see empty charts, he sees loaded springs. He sees unfinished business. He sees pressure quietly building while others look away. And he waits, knowing that the market never rushes but never forgets either, and that what feels uneventful now is often the very place where the next meaningful move is being shaped, slowly, deliberately, without applause, while patience is being tested and positions are being built beneath the surface long before price decides to move. When a stock walks up to resistance once, that doesn't mean much. It's just a visit. But when it comes back again and again, and each time it refuses to fall apart afterward, now you're watching a conversation between buyers and sellers. Most traders only see the line on the chart. I learned to watch what happens after price touches that line. That's where the truth lies. Have you ever noticed how some stocks retreat sharply after hitting resistance, while others barely step back at all? Resistance is not a wall made of stone. It's an area where selling has shown up before. That's all it is. The mistake most people make is assuming resistance automatically means rejection. It doesn't. It means a test. And like any test, what matters is the response. When price tests resistance and collapses, sellers are in control. When price tests resistance and holds firm, sellers are present but ineffective. That difference is everything. Are you judging the level, or are you judging the reaction? Each repeated test wears sellers down. Think about the psychology behind it. The first time price reaches resistance, sellers are confident. They've seen this movie before. They sell freely. The second time, some of them sell again, but not with the same conviction. The third or fourth time, many are already out. Meanwhile, buyers are still there, absorbing shares, willing to pay up slightly more each time. That's not randomness. That's pressure building. Doesn't it make sense that control shifts before price actually breaks through? What separates early breakout traders from late ones is the ability to recognize this quiet shift. Late traders wait for the line to break and the volume to surge. Early traders notice that price is no longer backing away. Pullbacks become shorter. Lows creep higher. The stock starts spending more time near resistance instead of retreating from it. That's not hesitation. That's confidence. Price doesn't hover where it's unwelcome unless someone strong is holding it there. I always paid attention to how a stock behaved after failing to break out. A weak stock fails and then slides, giving back ground quickly. A strong stock fails and then rests, as if it's catching its breath. It doesn't panic. It doesn't unravel. It just pauses and tries again. That behavior tells you more than any indicator ever could. The market reveals its intentions through behavior, not predictions. Are you watching how price behaves when it doesn't get what it wants? Repeated tests also expose false resistance. Sometimes what looks like resistance is simply an old memory the market is in the process of forgetting. Each test erases a little more of that memory. Shares that were once eager to sell at that level have already been sold. What remains are buyers. When supply dries up, price doesn't need excitement to move. It just needs a lack of opposition. That's how breakouts happen, quietly, almost reluctantly at first. This is where patience becomes a weapon. Most traders grow frustrated after 2 or 3 failed attempts. They label the stock, range bound, and move on. Professionals stay interested. They understand that failure without damage is not failure at all. It's preparation. Every shallow pullback is information. Every tight consolidation near resistance is a clue. The market is telling you that sellers are trying and failing. Are you willing to let that story unfold, or do you need immediate gratification? Repeated resistance tests also help define risk. When price keeps returning to the same level and holding above key support, your downside becomes clearer. You're no longer guessing. You know where the trade is wrong. That clarity is what allows early positioning without recklessness. You're not buying strength blindly. You're buying stability under pressure. That's a very different thing. Doesn't confidence come easier when risk is defined? There's a rhythm to strong stocks. They advance, pause, test, rest, and test again. Each cycle tightens the range and compresses volatility. That compression doesn't last forever. It resolves, and more often than not, it resolves in the direction of the underlying strength. The trader who understands this doesn't need to predict the exact moment of the breakout. He just needs to recognize that the odds are shifting. Preparation replaces prediction. Emotionally, this phase is difficult. Nothing dramatic is happening. There's no applause, no validation. You're trusting observation over excitement. You're trusting structure over headlines. That's uncomfortable for most people. But discomfort is not danger. In trading, discomfort often precedes opportunity. When repeated tests fail to produce downside, the discomfort belongs to sellers, not buyers. And markets move toward relieving the greatest discomfort. I learned to respect resistance not as a barrier, but as a proving ground. It shows you who is committed and who is not. It shows you how price responds under stress. A stock that keeps knocking is not weak, it's persistent. And persistence, in markets as in life, tends to be rewarded eventually, but only if you're still paying attention when it happens. Repeated tests without collapse are the market's way of saying, this level matters, but it is being negotiated. Negotiations take time. They are rarely dramatic until they are finished. By the time the agreement is announced in the form of a breakout, the real work is already done. Those who waited for the announcement missed the preparation. The trader who understands this doesn't chase. He observes. He lets others grow bored. He lets opinions swing back and forth. He focuses on one simple question after each test of resistance: is the stock weaker, or is it holding its ground? That answer, repeated over time, tells you more about the future than any single bar ever could. Because when resistance is tested again and again without consequence, when price refuses to retreat and instead stays close, calm and controlled, when selling pressure appears but leaves no damage behind, that is not hesitation, that is not indecision, that is strength revealing itself slowly, and the only real decision left is whether you are patient enough to recognize it, while the market is still pretending nothing is happening, while the chart looks ordinary, while the move has not yet announced itself, while opportunity is still quiet and waiting. A pattern by itself is just a shape on paper. It has no meaning until you know where it came from. Too many traders see a breakout pattern and treat it like a signal divorced from history, as if price woke up that morning with no memory. The market has a long memory. Every move carries the weight of what came before it. If you ignore that, you're trading shadows instead of substance. Have you ever taken a perfect-looking setup that failed immediately and wondered why? Where price comes from tells you what kind of energy is behind it. A stock breaking out after months of accumulation is speaking a different language than one breaking out after a sharp collapse. They may look identical on the surface, but they are not the same trade. One is built on acceptance and patience, the other often on relief and short covering. Relief rallies can look powerful, but they tend to fade once the pressure is released. Accumulation-driven moves have unfinished business. Do you know which one you're looking at? Context begins with trend. A pattern forming in the direction of the primary trend carries more weight than one fighting it. That's not theory, that's observation. When price moves with the larger tide, it needs less effort to go farther. When it moves against it, every step requires force. Breakouts against the dominant trend can work, but they demand more confirmation and more caution. The chart doesn't exist in isolation. It lives inside a larger structure. Are you trading the pattern or the environment it lives in? Distance matters. How far has price already traveled before forming the pattern? A stock that has doubled in a short time is not in the same condition as one that has gone nowhere for a year. The first may be extended, vulnerable to profit-taking. The second may be coiled, waiting for a reason to move. Patterns don't reset risk. Price memory remains. The market doesn't forget where enthusiasm peaked or where pain was felt. Those areas influence behavior long after the candles have changed. Time is another piece most traders overlook. A pattern that forms over weeks carries different implications than one that forms over days. Time filters emotion. Fast patterns are often emotional reactions. Slow patterns are decisions. Institutions don't rush. They take time to build, time to test, time to confirm. When you see a breakout forming after a long period of sideways movement, you're not seeing hesitation. You're seeing agreement slowly taking shape. Doesn't that inspire more confidence than a pattern that appeared overnight? Even the broader market context matters. A breakout in a strong market has a tailwind. A breakout in a weak market is swimming upstream. The same pattern can produce very different outcomes depending on the environment. That doesn't mean you avoid trades in difficult conditions, but it does mean you adjust expectations and risk. The market is a system, not a collection of independent charts. Ignoring that is like sailing without regard to the weather. Context also includes behavior around key levels. How did price react the last time it was here? Did it explode away, or did it stall? Did it spend time, or did it reject quickly? Those reactions leave footprints. When price returns to those areas, it often responds in similar ways unless something meaningful has changed. Patterns don't override memory, they interact with it. Are you reading the footprints, or just admiring the shape? News and fundamentals don't need to be fully understood, but their effect on price should be respected. A stock that holds steady despite negative news is telling you something. A stock that can't rally on good news is telling you something else. Context isn't about becoming an analyst, it's about noticing how price absorbs information. Strong stocks digest news quietly. Weak stocks react loudly. That behavior influences whether a breakout has staying power. I found that many failed breakouts weren't failures at all. They were misread contexts. The pattern worked exactly as it should have given where price came from. The trader just expected more than the situation allowed. When you align expectations with context, frustration drops and consistency rises. You stop blaming the market and start refining your judgment. Context also shapes your mindset. When you know the background of a setup, you're less likely to panic on normal pullbacks. You understand what's noise and what's damage. That calmness is not emotional strength, it's informational strength. Confidence comes from understanding, not hope, and understanding comes from context. Patterns are tools, not answers. They highlight potential, not destiny. The market decides how much potential is realized, and it does so based on conditions built long before the pattern appeared. When you respect that, you stop forcing trades to meet your expectations and start letting trades reveal themselves on their own terms. A trader who ignores context trades mechanically. A trader who understands context trades intelligently. The difference shows up over time, not in any single trade. One survives drawdowns with perspective. The other is constantly surprised. The market doesn't reward surprise. It rewards preparation. Every chart you look at has a story behind it. It tells you where money has been trapped, where it has been patient, where it has been rewarded, and where it has been punished. Breakout patterns are just the latest chapter, not the whole book. If you only read the last page, you'll never understand why the ending unfolds the way it does. So before you act on any breakout, you pause and ask yourself simple questions. How did price get here? How long did it take? What kind of behavior did it show along the way? What kind of market is it in now? Those answers don't guarantee success, but they tilt the odds. And trading has always been about tilting odds, not eliminating risk. Because when you finally see a breakout through the lens of its full context, you stop seeing lines and candles and start seeing intent, pressure, memory, and positioning, and the trade no longer feels like a guess, but like a response to something that has been building for a long time, quietly, deliberately, shaped by everything that came before it, waiting for the moment when price decides to acknowledge that history and move forward from it, carrying all of that context with it, as it begins to unfold. Most traders spend their energy trying to predict what the market will do next. They want certainty before they act. They want the market to explain itself in advance. I learned early that the market owes you no explanations. It doesn't reward forecasts, it rewards readiness. Being ready for a move is far more valuable than trying to predict it, because prediction locks you into an opinion, while readiness keeps you flexible. Have you noticed how the market has a way of embarrassing strong opinions? Prediction feels comforting because it creates the illusion of control. When you predict, you feel decisive. You feel intelligent. You feel ahead of the crowd, but the market has no obligation to follow your logic. The moment you commit emotionally to a forecast, you stop observing. You start defending. You interpret new information in a way that supports what you already believe. That's not trading. That's arguing with price. And price always wins. Isn't it strange how often being right still ends in a loss? Readiness, on the other hand, is quiet. It doesn't announce itself. It doesn't demand validation. Being ready means you know your levels, your risk, and your conditions for action, but you're not married to any outcome. You're prepared for what might happen, not convinced of what must happen. That difference changes everything. When price moves, you respond instead of react. You don't freeze because the move didn't match your expectation. You move with it. I never tried to guess when a breakout would occur. I studied how one forms. I watched how price behaved near key areas. I noted whether it held ground or lost it. I observed whether selling pressure caused damage or merely delay. All of that was preparation. When the move finally came, I didn't need excitement or confirmation. I already knew what I would do if certain conditions appeared. That's readiness. It removes hesitation at the moment when hesitation is most costly. The trader who predicts waits for the market to agree with him. The trader who is ready waits for the market to reveal itself. One approach is rigid, the other adaptive. Markets change character without warning. Volatility expands and contracts. Trends strengthen and weaken. No prediction survives contact with live price action, but preparation survives everything. Are you building opinions or are you building plans? Readiness also protects you emotionally. When you predict, every tick against you feels personal. It feels like an argument you're losing. When you're ready, every tick is just information. If the market does what you prepared for, you act. If it doesn't, you step aside. There's no drama in that. No frustration. Just execution. Emotional stability in trading doesn't come from confidence in being right. It comes from acceptance of being wrong. Most losses grow large because the trader was trying to be right. He predicted a move, entered early, and then watched price drift the wrong way. Instead of reassessing, he defended his forecast. He widened his stop. He added explanations. The loss became a lesson only after it became painful. Readiness avoids that trap. When you're ready, you already know where you're wrong. There's no debate. The market tells you, and you listen. Being ready also changes how you view missed trades. When you predict, missing a move feels like failure. You feel left behind. You chase. When you're ready, missing a move is just part of the process. You weren't prepared for that specific entry, so you didn't take it. There will be another opportunity. The market is generous to those who are patient. It's ruthless to those who are desperate. Which side do you want to be on? Preparation happens during quiet times, not during the move itself. You prepare when the market is dull, when charts look uninteresting, when nothing is happening. That's when you mark levels, define scenarios, and decide in advance what matters. When the move begins, there's no time to think. Thinking comes before. Execution comes after. Most traders reverse that order. They think during the move and prepare after the loss. Readiness also means knowing when not to act. Not every breakout is yours to trade. Not every setup fits your risk tolerance or your strategy. Predictive traders feel compelled to have an opinion on everything. Prepared traders are selective. They wait for alignment.